Are you thinking of setting up a trust? Or maybe you've heard someone promise you massive tax savings by moving everything into a trust. Be careful. The IRS has put these schemes in the crosshairs. Today, I'm breaking down how the IRS is investigating and prosecuting abusive trust arrangements, what makes a trust legitimate, and how you can stay on the right side of the law. Stick around. This could save you from hefty fines or even criminal charges. I'll also share real examples of false claims promoters are making and the truth behind them. You'll want to hear this before making any decisions. Let's get started. First, what exactly is a trust? A trust is a legal entity formed under state law. Someone, the grantor, transfers property to a trustee who holds and manages it for the benefit of someone else, the beneficiary. Trusts can be fantastic tools for estate planning, charitable giving, caring for minors or others unable to manage finances. But all trusts must comply with tax laws outlined by Congress in sections 641 through 684 of the Internal Revenue Code. A legitimate trust is about protecting or managing assets responsibly. An abusive trust, on the other hand, is set up to hide ownership, disguise income, or illegally avoid taxes. Sound familiar? The IRS has uncovered schemes where the trusts are misused to depreciate personal assets like a home, deduct personal expenses, split income across multiple entities, underreport or wire income offshore. These tactics are not allowed under U.S. tax law. Even with the high cost and complexity of trust filings, Forms 1041, 3520, 926, and many more, people still pursue abusive trusts thinking they'll avoid taxes. The reality, number one, trust tax rates are higher than individual and corporate rates. Number two, there are no hidden tax benefits. And three, the courts almost always rule against these abusive structures. And if the grantor maintains control, the IRS treats it as a grantor trust, making the grantor fully responsible for taxes. Currently, two main schemes are under IRS scrutiny. Number one, the domestic package, where layers of U.S.-based trusts passing income along to reduce taxable amounts. And number two, the foreign package, offshore trusts outside U.S. jurisdiction attempting the same thing. Promoters sell these schemes using seminars, flyers, and online ads. But remember, the IRS knows the playbook. Let's debunk a few dangerous myths. The first false claim is setting up a trust eliminates your taxes. The truth? The IRS still expects taxes to be paid on income generated by trust assets. The second false claim is you can transfer income into a trust to avoid income tax. The truth? Income remains taxable to the person who earns it. The third false claim is you retain full control over your assets. The truth? A true non-grantor trust requires giving up substantial control to the trustee. The fourth false claim is personal expenses or depreciating your home through a trust is deductible. The truth? Absolutely not. Personal living expenses and home depreciation are not deductible through trusts. The IRS has trained teams to detect abusive trust schemes. Violators face civil penalties up to 75% of underpaid taxes, criminal fines up to $250,000, and up to 5 years in prison per offense. The bottom line, if it sounds too good to be true, it probably is. Setting up a legitimate trust can be a powerful tool, but never used for the purpose of evading taxes. The IRS is committed to making sure everyone pays their fair share. If you're thinking about creating a trust or have questions about estate planning, talk to a qualified professional. Don't fall for risky shortcuts. Thanks for watching. If you found this helpful, like, subscribe, and share the video. And as always, stay informed and stay compliant.